Welcome to the 3 Edge Weekend Review for the week of April 22nd. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge. And joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. Today, Steve and I will be discussing investing during periods of market bubbles. As we know, the U.S. equity market has had quite a run from late fall of last year through the first quarter here in 2024, with the S&P up over 20% during that time. However, since the beginning of April, U.S. stocks have been experiencing greater volatility, economic data indicating that perhaps inflation is not necessarily declining as quickly as investors and the Fed had hoped. So maybe more of a mixed bag here, so we'll have to see how things proceed from here. So Steve, this week, I've actually been at a conference, met with many independent advisors and wealth management firms that we work with on behalf of their clients. And I must say there was a good deal of concern about the U.S. stock market being in this quote-unquote bubble territory with stretched valuation, and frankly, a good deal of uncertainty as to where we go from here. So my first question for you is actually, if we're going to talk about market bubbles, maybe we could begin by just having you give us a definition. What constitutes the market bubble?
Well, Fritz, a market bubble is when stock prices rise far above their underlying value. This coincides usually during periods when animal spirits are high, and animal spirits just reflect how exuberant investors are, how excited they are. And we've studied every market bubble going back to the early 1700s, and there were some common patterns. During the bubble, investors are buying not because of fundamentals necessarily, but because they want to ride the trend. They want to keep up with momentum. And that encourages other investors to go ahead and jump in and ride that same trend. Otherwise, they have fear of missing out. And it's really painful when other people in your mind are making lots of money on the way up and you're not, and you want to jump in. And then that forms a virtuous cycle. When the buying happens because the market's going up, it encourages more investors to come in. And you have the self-reinforcing feedback loop that just causes the market to go higher and higher until some catalyst comes along to stop it. And the catalyst could be a black swan, an unpredictable exogenous event that comes along. It could be monetary policy getting really tight. There could be a number of things that happen that could stop the bubble, but often the bubbles go far longer than logic might suggest. So what's tricky about market bubbles is that they do tend to go up far higher than the fundamentals might suggest. And markets never go in a straight line. They tend to go and make a new high, then there's a correction, and people worry, well, maybe that's the end of the bubble. And then they come and they exceed that previous high. So it's often hard to tell when this bubble might stop. And I would say there are 3 properties that are consistent with all the bubbles we studied. One is there's usually, in the beginning, some high degree of stimulus, whether it's monetary stimulus or fiscal stimulus. It creates very loose financial conditions. And this is a precursor to the animal spirits running. Second, there's always a new narrative, and it's typically around a new technology that changes everything, that everyone gets excited about. In the 1700s, it was the new technology of ships being able to go to the New World to extract natural resources and bring them back to Europe. In the late 1800s, it was the new technology called railroads, and so on and so forth. And now we have AI as a new technology. And then third, usually another sign that you're in a bubble is that people start saying that we're in a new era. It's unlike anything that happened before, and it justifies why prices can be far above their intrinsic fair value. So in the past, the Federal Reserve Board actively tried to stop or prevent bubbles. And there was a famous Fed chair called William McChesney Martin. And he once said, when the party gets started, it's time to take away the punch bowl, meaning that before things get out of hand, it was the Fed's job to try to tighten monetary policy and not let the bubble get out of hand. And then some years later, Alan Greenspan, as the head of the Fed, changed that policy and said, look, it's too hard to know when you're in a bubble. It's only easy in hindsight. So we're not going to try to prevent bubbles. We're just going to try to clean up the mess after they burst. But there's a lot of controversy if that was a good idea. So it is hard to know if you're in a bubble until after it bursts.
All right. Excellent. Very helpful definitions there. So my second question would be, so what would be the evidence that we're seeing or have seen recently that would tell us that definitely U.S. market in particular or the equity markets are in bubble territory?
So over long periods of time, the stock market's price per share, earnings per share, and sales per share all grow at the same rate. And you can do a 100-year test and look at the compound annual growth rates of those three items. And you'll find that within a couple of decimal points, they all grow at the same rate. And it makes sense because logically, owning a part of a business means you own part of that revenue stream or that earning stream. However, in any short-term period, human behavior and psychology and emotion can drive prices to go far above intrinsic value or far below intrinsic value. If you're in a period where people have fear of missing out, or they're exuberant or greedy, or you have those animal spirits, you can see the prices go way above where they belong eventually. Or a period where there's a lot of fear and a lot of panic, the price can go well below that intrinsic value. Right now, today, the price per share is well above the sales per share. In fact, to such a degree that it's one of the widest gaps we've ever seen. So that gives us a sense that we're most likely in a bubble. We compare it with the gap that we saw before the crash of 1929 and the Great Depression. We're even a little bit beyond that. We compare it with the gap we saw when the tech stock bubble rose and then burst. We're even a little bit higher than that. If we compare it against the crash of 1987 or right before the great financial crisis of 2008 happened, we're a little bit above that. So I think it's hard to ignore that we're most likely in a bubble. And then it remains to be seen what the catalyst might be to stop it. And if you think about the three properties I mentioned of all bubbles, one is we've had the most massive fiscal and monetary stimulus ever seen a few years ago and some leading up to now. Second, we've had a tech narrative. It's all been about AI. And third, you're seeing more and more calls by Wall Street investors saying, well, don't worry about the old statistics. We're in a new era. Everything's different now.
It's different this time. So, as always, my final question is based on what we've discussed here today about stock market bubbles. How should investors think about positioning their portfolios in this environment?
Well, it's not so simple because bubbles can last far longer than logic would suggest. But when they fall, they can fall quite sharply, and it's hard to get out of the way. So the way I would like people to think about it is that investors are trying to navigate and manage two different kinds of pain. The fear of missing out is a real pain that people have, but the fear of losing money, Fulham, is, I can say from experience, is even a worse pain. But we're in a bubble. People forget about how they felt during the last big bear market or correction. And because of recency bias, people are a lot more attuned to the fear of missing out and feeling like they weren't fully invested, so they're not keeping up with the biggest performing market. And that's real. And so we think at a point like this, even though we think the markets are highly overvalued, it can be a mistake to have no money in equities or no money in the U.S. stock market, because this could last quite a bit longer. And that fear of missing out can finally catch up and encourage people to throw in the towel and put all their money in the U.S. stock market right at the peak. And we've seen in history that happens over and over again. So we think it's a mistake to not have any money in the U.S. market at this point. On the other hand, if you have all the money in the U.S. market, and we are in a bubble, and the peak happens and it bursts quite suddenly, it's hard to get out in time. Also, what's so difficult is we'll take the current period as an example. On March 31, we had a market peak, and since then, we've had a 5% correction. Now we're starting to rebound again. And a sign that the bubble might have peaked is if that next high level is below the previous high, and the next low is below the previous low, that's a sign that perhaps the bubble is over and we're now in the period of a correction. But we could rebound and make a new high, and that's a sign that the bubble will continue, and it's too early to tell. But I can remember in the past, in the year 2000, there were so many people that were convinced after the bubble burst that every time there was a rally, that the bubble was still there, they were staying invested, and they followed the market all the way down. So we think it's a mistake to be at either extreme, but we'll keep watching our models, we'll keep watching the market action, and when there's more confidence that the bubble either will continue or it has ended, we'll act accordingly.
Great. Excellent. Thank you. Thank you for your insight on this important topic. And I can tell you from having returned from this conference, it's something that people are really talking about, what exactly to do in this environment. So very, very helpful. So that will do it for Steve and me for this week. We will be back again next week with another edition of the 3Edge Week in Review. As a reminder, all our videos are always available on our 3Edge YouTube channel. And if you know someone who you think might enjoy and benefit from our weekly videos, please feel free to share them. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.